It is as bright as daylight. The most popular haven asset this year has been gold. Demand has been on the rise for alternatives to risky bets such as equities and crypto. Gold is a steady store of wealth. Unlike fiat currencies, its supply is finite. It is universally recognized and cannot be devalued by overprinting. And as the cost of living rises, so does the price of bullion. Gold investment is considered immune from inflation or the erosion of purchasing power. The yellow metal holds its shine even in dark times, when geopolitical conflicts unfold or recessions take hold. When the economy is shaky, investors often flock to gold. In past crises, gold managed to retain its value while stocks turn volatile. Experts note a major driving force behind the recent gold rush: bulk buying by big players such as the central banks.
We all understand the geoeconomic, largely speaking, economics and interest rates. But what we're not anticipating really, and not really building into our calculations, is the huge levels of debt. Now, we obviously are constantly reminded of the debt in the United States, but I'm talking about, for instance, the need for the UK and the rest of Europe to rearm urgently at the moment, and which means that they will need to issue debt to do so. There is very little growth in Europe. There is very little growth anywhere in the world, to be perfectly honest. And the only way that they're going to have to spend 4% of their GDP getting their rearming their countries is to actually borrow. And so I think the next major threat to the world economy internationally is going to be these burgeoning levels of debt, which are only going to increase. And I think that is part of what's being reflected in the gold price, because as this debt increases, you undermine fiat currencies, and you just continually add to this enormously expanding bubble, which is at some point going to come back to roost.
Just like anything, the price of gold is affected by supply and demand. If supply is thin or if demand spikes, prices will rise and vice versa. Bullion prices also tend to move inversely with interest rates, and that's because the future yield from gold is seen as more attractive than that of bonds. Now, just a hint from the Fed about potentially lowering rates sometime this year is enough to send gold skyrocketing. Even at already dizzying heights, experts are convinced that prices could continue to push their limits.
Is it overpriced? No, I don't think it is. Is it possible it consolidates? Yes, I'm afraid I have to say it's possible. That always happens. But it doesn't feel to me that the normal players in the gold market around the world, the people that you normally associate with gold price rallies, such as investment bank trading, for instance, have had this trade. It's remarkable, but it feels like they've been left behind. But I think it's a consistent move. I do not think there's anything on the horizon that is going to point to a significant decline in gold at all. Far on the contrary, I think we're staring at a situation where gold could continually move higher and leave many of the investment institutions behind.
Remember, though, all that glitters is not gold. No investment is completely safe. Gold can fluctuate in price, and it doesn't generate income like dividend-paying stocks or bonds. Still, its history as a store of value and its performance during tough times can make gold a bright spot in a balanced and diversified portfolio. For CNA Explains, I'm Olivia Marzuki.